Hey everyone, this is Vincent, and in today's topic, I am going to talk to you regarding about endowment. So what is an endowment? Endowment itself is basically marketed as a forced savings policy, and it requires you to save for a certain amount of years before it matures and giving you a lump sum. And there are three key points itself that you should know about endowment. First of all, common misunderstanding. Some people thought that endowment itself is an insurance that covers their financial portfolio, which is not, because an endowment itself, the main objective of getting it is to save and earn the higher return, even though it comes with insurance, but the insurance does not sufficiently covers the financial protection gap that you need. So if you have a lot of endowment, don't think that you have a lot of insurance itself. It doesn't necessarily means that way. A proper life plan or term policy itself will give you adequate coverage, but not an endowment. And the second point, endowment is differentiated into two types. So the first type is a participating endowment, and the second type is a non-participating endowment. A participating endowment, basically what it means is it participates into the fund performance of the company. So usually insurance companies, they do it into a 70% bonds, 30% equities portfolio, and they will earn a return from this investment pot. So out of this investment pot, when they have this molding process that when they earn more, they have to keep a bit of the reserve, but so that when in the case that they are earning lesser, they will actually give back the additional bonuses. This is what they are trying to do to smooth out the returns. But participating policies are not guaranteed. So they are usually made up of two components, one guaranteed component and one projected basis component. So you have to understand about that. And the second type of policy is a non-participating policy. Usually policies like this gives guaranteed returns and they guarantee your principal. So if you are someone that can't take risk at all, basically a non-participating endowment is something that is suitable for you. And the third thing that you have to take note, there's two returns that is stated on the endowment policy illustration. So usually it's 4.75% and 3.25. But are you really getting the 4.75% or 3.25? Basically, these are not the actual returns. The 4.75 and 3.25 are just projected basis, and it's showing you what happens and what is the amount that you will be able to collect if the fund performs at 4.75 or if the fund performs at 3.25%. But it does not mean the higher or lower tiering. Basically, it's just an illustration figure to let you see what are the sums that you are looking at. And policies like this usually have an effective interest rate that they show you what is the actual interest that you get at maturity. So if you are talking to your financial advisor, your agents, your banker itself, and they are showing you recommendations of endowment policies, take a look at it and try to understand what is the real effective interest rate. That is basically what is important to you. Okay, so what is the pro and cons of this policy itself? The good thing about endowment usually is pretty conservative, and more or less principal are 100% guaranteed, or they guarantee up to a certain amount, maybe 60, 70 or 80%. So endowment policies usually are safer compared to traditional assets that you invest like stocks or maybe in fact bonds. It is usually good for people who have a lower risk profile, and at the same time itself, if they find that they have a goal that they want to save towards too, you can start a regular saving policy to aim for maybe for your children's education, or by maybe let's say within 10 years you want to purchase a house and you're trying to save up for a lump sum. So endowment that comes in about 10, 15 or 20 years itself, that would be something suitable for a conservative investor. What is the con about this product? First of all, product comes with illustrated yields, which means they are projected basis and they are not guaranteed. So basically the company itself, they don't give a guaranteed return, and if you are looking for guaranteed return, this product might not be suitable for you. And moreover, taking into account, if we are looking at the yield for a 10 years instrument of endowment, you have to see which are the companies that is paying you a rate that is suitable for you, which you find it acceptable. Because in current context, Singapore savings bond effective interest rate is about 2.5%, and if let's say you are getting a 10 years endowment and it's paying you 2.5%, then in that case you might be better off getting a Singapore savings bond instead. So do your shopping right and try to understand how the endowment works in terms of the tenor. Is it a fully guaranteed instrument, or is it a partially guaranteed instrument? And at the same time, try to find something that suits your risk appetite, and of course to know whether the return is appropriate for you. So that will be all for today, and I will see you in the next video tomorrow.